David Kudla joins us. He's the founder, chief executive officer, and chief investment strategist at Mainstay Capital Management. Hey, David, early into this earnings season, but again, double-digit earnings is kind of what analysts are forecasting, and some people see that as a head risk. What's your sense as to earnings and kind of support for this market?
Well, I think that earnings are going to be the catalyst this year. We need earnings to be strong. We're looking at 12% earnings growth. Our estimate for the fourth quarter, as you said, is the introduction of the segment. We had just blowout bank earnings last week. Fantastic. We had Netflix come through with very good news. And we think that we'll have a strong earnings season, and we'll continue to have strong earnings into this year. There's some pretty lofty forecasts, looking at 15% earnings for 2025. And there are some problems that could come. But, if we look what's happened so far, everyone was worried about tariffs. I was quoted in an article last week about tariffs that I think that President Trump will use tariffs more as a negotiating tool than just a simple economic tool, just impose them to impose them. He's threatened tariffs at 25% on Canada and Mexico, 10% on China, but hasn't done anything yet. His announcements on that, with everything in the last couple of days at least, have been pretty benign. So the market has read that as good news, because that would be certainly an impact because of impact costs, input costs, potential inflation driver that could be an impact on earnings. But so far, we continue to look for good earnings in 25, and we're seeing good earnings surprises so far for the fourth quarter of 24.
So to that point, and I'm kind of laughing at myself as I say this, but I mean it, will 2025 be the year of the stock picker? Will this finally be the case, that you may not see the whole index rise as much, but individually, some of these sectors, some of these names can really outperform?
Yeah, we hear that all the time. I mean, we hear it all the time. This will be the year of the stock picker. Right now, it's time to pick stocks. You just can't buy the market. I would say in this year that is going to be true. It's important to us as tactical asset allocators. That's what we've been talking about with our clients and the other people we're educating is, in an election year, there's so many people that moved to the sidelines. Look how much money went to money market funds last year, just because of uncertainty or such a conviction about if this candidate wins or this candidate wins, what that'll mean for the market. What's really most important what are the policies of each of those candidates? The thing to do is stay invested. 2024 proved that again. Best election year in decades, right, for the markets. And as we roll into 2025, we're doing well again, but we're seeing where policy is going to matter, and we're already seeing where that's affecting these different sectors and different companies. Look at Oracle, with this $500 billion project that's been announced, they might participate in. They've rallied on that news. So it is going to be going through sector by sector, industry by industry, which with the policies that are going into effect, which will be favorably impacted, which won't. And yes, that will drive, I think, more of a selection of at least sectors versus stocks or sectors and stocks versus just being in the index.
So, David, one of the stats I see thrown about a lot, money market funds, and now it's close to $7 trillion in assets. Is it fair to think of that as fuel for potential stock and bond rallies, or is that just money that is in money market funds and don't expect it to come into riskier assets?
I think it's fair to think of it as fuel or dry powder for the markets to a degree. As I said, we know a lot went into the market or went into money markets last year because of concern over the election. I think that'll start coming back out. But also we have now the highest interest rates, right? The highest yields on money market accounts that we've had in years, over a decade. And so people can enjoy a 4.5%, 5% return in a money market account with a guaranteed return and feel very safe about that. But you look at last year, there were people that did that and then saw what the market did and looked at that opportunity cost. So I think that as Trump rolls out his policies, we see that the economy is doing maybe better than some might expect. It certainly doesn't look like a recession right now. That we could see the markets continue to do well, and we'll see that money come back in, which came out a lot right, at the end of last year, early this year, and really, when we're setting a record for money market accounts, that's a lot of cash on the sidelines.
All right, we appreciate it. Thank you so much for the insight. Looking forward to how this year unfolds, I got to be honest. David Kudla, founder, CEO, and Chief Investment Strategist at Mainstay Capital.